Welcome back to Proof of Vision, everybody. Today we had Sam, who's the CEO of Phoenix Labs, who is the entity behind the Spark protocol. Uh, for anybody that doesn't know who Spark is, which I'm sure a lot of you do, they're kind of the first sub DAO from Maker. And it was a great episode. We got into the origins of Spark, kind of branching off from Maker into its own entity. Talked a lot about the liquidity layer and the vision that the Spark team has for how this will kind of proliferate over the long term, and some of the mechanisms that they've got in place to ensure that everybody's got a transparent look into what's backing DAI, what's backing the savings rate, what assets are allocated to, and importantly too, how does Spark kind of play a role in the next phase of growth for DeFi and kind of bridging the TradFi and RWA world with DeFi. So it was a great episode. Obviously, if you guys enjoy it, please like and subscribe, and we'll see you on the next episode of Proof of Vision. Thanks. Take care. All right, welcome everybody back to another episode of Proof of Vision. We have a great episode for you lined up today. We've got Sam, the CEO of Phoenix Labs, who is the company that's behind Spark Protocol. Sam, how are we doing today?
Doing pretty good. How about you?
Fantastic. Can't ever complain. Yeah, so I always like to kick things off to tell the users a little bit about your origin story. So give us the rundown. How did you get into crypto? What were you doing before this? What led you into the cryptocurrency space?
Yeah, so I mean, I've been a software engineer for a long time, on the order of 20 years, who knows? Time passes quicker and quicker. But yeah, so I used to do video game development before I got into crypto. I joined, so at first I was like a hobbyist investor. I think that's how most people start. Like I came in on the 2017 ICO cycle. I was aware of Bitcoin like pretty early on, but Ethereum was more interesting to me as a programmer, the smart contracts and stuff like that. So once I joined, or once I bought some ETH, and then I started researching projects in like all the ICOs that were coming out. And Maker was the first one that really stood out to me. I'm a fundamentals investor primarily, so I saw cash flows, revenue, this kind of stuff. So and like a product that people wanted to use. So this was what interested me in Maker. So kind of just learned more and more about the protocol as a hobby over the next few years. Then I started dipping my toes into smart contract development in 2020. Built my first contract. Actually, it was the Peg stability module. It was one of the first few contracts that I built that actually went into production in Maker. And then the engineer at that time, the foundation was Maker Foundation was dissolving, and so the DAO was spinning up, taking control of the protocol, and core what were called core units were forming, and I was asked to join the protocol engineering core unit. So I joined that, and we did that for 2 years, operating the protocol, growing the protocol. And then in 2022, there was the restructuring of the DAO. The DAO was kind of, it was a nice first attempt. This very flat structure, token weighted voting. I think it was just like the default naive solution to DAOs. And so it was recognized this structure wouldn't scale with like serious money behind it and stuff like that. So there was the restructuring in 2022, and that was the birth of Spark and us forming Phoenix Labs, which is my company, which is the dev team that's working on.
Awesome. Yeah, it's kind of coincidental actually. We've got two of the Maker, I guess, sub projects, I'll call them, back to back. So like last week we had Chronicle on, so I'm sure you know the Chronicle team.
Great guys.
Yeah, no, great conversation with Nick. But yeah, I mean it's funny to hear like a similar like origin story and a similar description of what was going on with Maker, at that particular time. Okay, so Maker was restructuring. You guys decided to kind of branch off and kind of make it a, an official sub DAO of MakerDAO. Let's talk about that a little bit. Like what made you want to transition, I guess, into this at the time? I think it was more focused on SparkLend, the borrowing and lending protocol. But maybe take us through that. Like what was the value that you saw that was maybe missing from the Maker structure, and what were you guys trying to accomplish as a result of Spark?
Yeah, so maybe let's go back and I can give you my viewpoint about being inside, both of these structures. And so, really, my goals have been very product focused, growing the protocol, new markets, this kind of stuff. I've always been interested in that. I'm less interested in the DAO governance type of stuff. And so, under the previous structure, it was getting increasingly hard to like do basic stuff like growth initiatives. You basically have to, put up a forum post and then argue with, the entire random people on the internet to get any sort of budget for anything. So it just wasn't working that well. So from my perspective, I've always just wanted to kind of like I see some market that we're missing, and so I want to cater to that market. And so um, one of the things that was missing from the Maker CDPs at the time was rehypothecated collateral, which was becoming increasingly important for when this is when LSTs were becoming popular. So we recognized that like looping ETH is the primarily the use case for this, and we recognized that was going to be a big use case. In addition to that, Maker was missing things like cross collateralization that we saw was important in lending markets. So we took a look at the landscape about. We didn't want to build something from scratch because there's existing open source software. We might as well use that. So we look at like Compound, Aave, and we even looked at Euler V1 at the time. And Aave V3 had just come out, and it had this emote attached to it, so it was the best candidate in our view to be a state of the art lending market. The Aave team, they're world class engineers. They do good work. Where we trust the code quality they put out. There's lots of Lindy behind their protocol, so that was the winner. And so we decided to use that as the basis for SparkLend to enable users to get all the liquidity access from the Maker protocol, but packaged up in a modern lending market format. And so this is like we didn't like if we were to just launch yet another lending market, that was not the key insight. The key point that made SparkLend so successful is the combination of the lending market with the liquidity injection from the Maker protocol called the DAI Direct Deposit Module or D3M.
Gotcha. Yeah, that's the one. I'm glad you covered that because I was going to ask you, like, yeah, like what's the point of like launching another money market, right? Because we're saturated with them, right? You just mentioned quite a few, but I think Spark, in my view, right, it's got like this specific purpose that has obviously expanded, since then, which is kind of the proliferation of the of DAI, right, and USDS now, now it's rebranding to Sky. Um, and I think you guys have done a fantastic job of that. So like let's break it down a little bit. And I want to go, I guess, talk more about the liquidity layer. That's what I find the most interesting in terms of like the products that you guys offer. So let's talk about the strategy behind, I guess, the Spark liquidity layer. What are you guys trying to accomplish there? Um, and how does that, I guess, all of those, those allocations that you guys are making, how does that circle back into the savings rate or the DAI and Sky ecosystem?
Yeah. So maybe I'll go through the whole evolution of this because this goes back actually quite a bit. And so this starts out with the D3M, the DAI Direct Deposit Module. And so the insight here was that we could, there's the internal Maker CDPs that were originally launched. But other lending markets like Compound and Aave were gaining steam at the time. And so these are users who are borrowing, there's DAI markets on each of them. So it was recognized we could just mint DAI and then stick it into their protocols to gain access to their users. And so this sort of, and this actually goes by a few names. I mean, this technique is used by a lot of different stablecoins. Like it can be called AMO or, direct injection. Like there goes by a lot of names, but it's all fundamentally the same thing. Um, we actually, the first connection we did here was into Aave. So we deployed the D3M, which connected to Aave. When was that? I think that was 2021 October. That was spun up into the Aave V2 market. And it was a great success. So the next iteration of this was the SparkLend. We wanted an internal money market connected with this D3M module. But really, this liquidity injection generalizes to basically everything. And so the D3M module, it was a good first iteration, but it had a lot of faults. It was DAI only. It was only on Ethereum. Doing an integration required on-chain components for like how to allocate and stuff like that, which meant the dev time was actually quite large. The code was pretty complex, so it took months to build a new integration with the old D3M. So the Spark liquidity layer was basically the culmination of all these learnings and the most generalized version of this. So it supports multiple assets. We support DAI, USDS, and USDC, and now actually we support USDT as well. So it's meant to be general across all assets. It's multi-chain fundamentally, so we have this deployed on Ethereum, Base, and Arbitrum, and we'll be scaling this up quite rapidly to basically all major chains very shortly. As well as the what we call like the controller logic is now off chain, so we can do very advanced things like um, very rapid rebalancing, changing the algorithms to do the rebalancing, and especially with the complexity of we're rebalancing across all these targets. So the D3M was like really like the logic that was doing the controlling was just like focused on like one thing. Now we can take the entire market into account, off-chain data, is the market bullish or bearish, or AI driven type stuff. It can be quite advanced, and all this logic is off-chain. But the on-chain component, the security mechanism keep it such that the off-chain component never has custody of any funds at any point. It's just very restrict. It's like a whitelist of things that it can do. But within that set of whitelist, there is like a lot of flexibility, and so this off-chain controller is able to quite advanced reallocations across basically every opportunity in DeFi, CeFi, and TradFi. So yeah.
Alchemix Finance empowers you to spend and save at the same time with a self repaying, interest free, non liquidatable loan. Deposit your assets and access your future yield today. Available on Mainnet, Arbitrum, and Optimism. Head to alchemix.fi to get started.
Nice, nice. And so the process for, I guess, the having your asset whitelisted for like the Spark liquidity layer to deploy capital to it, is that something that's currently controlled by governance, or is that simply kind of a more of a white glove service that that Spark is holding, and kind of assessing internally to like curate the yield opportunities?
Yeah, I mean, we can go into more detail about the governance process, because the short answer is it goes through Spark governance.
Right. Gotcha. Okay. And so that makes sense. So then, I'm thinking about this in terms of like, yield optimization. You see a lot of this now, right? Where there's these curated vaults now that everybody are coming out with to like optimize your capital across, this set of strategies or this set of assets. And so that's kind of like, it's kind of what you guys are doing here, right? So in terms of like growth vectors, right? You said you started with Aave, then you added Spark. One of the very popular ones I think that caught my eye that you guys got a lot of traction with too was, when Athena came out. And you guys I think deployed into the Morpho. You guys have a Morpho curated vault that you're deploying capital into, and people were looping through that vault, into Athena, and Athena related assets. Um, the question I have for you there is you guys were very early, and so was Maker, right? Very early to Athena, whereas you guys are kind of allocating at the time to these like blue chip trusted protocols. Athena was very early, right, in their protocol development when you guys kind of made that jump. So talk about that a little bit, because that was like I think Maker and Spark like there was a lot of pushback about it at the time, because of that, right? It's a new protocol, it's brand new, and like you guys made a very calculated bet. Talk about that a little bit. What did you guys see, in the Athena and Morpho model that you thought was going to be very attractive for Spark and for Maker?
Yeah, for sure. And I mean, these things should always be treated in not terms of like absolutes, but risk-adjusted yield is what you're looking at always. And so the funding rates were like ridiculously good at the time. And so the structure was sound. Doing a basis trade or cash and carry quite a common, straightforward strategy within hedge funds. So um, this was viewed, the structure itself all made sense, and the due diligence didn't turn up anything um, improper. So it was viewed we could proceed. So, I mean, with Athena in particular, there's actually not that much that's on chain. It's mostly like an off chain, more traditional CeFi style structure. So it's basically just you do the due diligence on what they're doing with the assets off chain. And then the on chain component, most of the technical due diligence was actually done on the Morpho protocol. So that was just launched a few months earlier. But it was, I mean, it's gone, went through the regular process we go through for anything. We looked at audits and stuff like that. And but the protocol was just dead simple. Like we could read it ourselves as engineers, and like I personally went through it. I'm like, there's 600 lines of code. I'm like, everything is pretty straightforward. So like we had super high confidence very quickly um, in the technical side with Morpho, and then additionally, there, because we're using Morpho vaults, we get this additional equity buffer that comes from the users who are doing the looping. So even if there's some fairly substantial loss in the Athena protocol, and they have their own insurance too, actually, but so if there's a loss, like even blowing through their insurance, it would still need to go through the junior capital positions that the loopers are taking, which was like an additional 10%. So there would need to be losses like over 30% before this was starting to hit the Maker protocol. So that would even like survive, fairly catastrophic custodian hacks, this kind of stuff. Maybe not everything, but like it could. It was pretty robust. So we thought this was a good first iteration to go into, and the yield was just so high that it was like the risk adjusted yield was worth it. But that's basically the bottom line when we're doing any of this calculus, and this turned out to be correct. That vault grew quite rapidly. At its peak, it was about 700 million deployed into there. And since then, we've actually started more moving into the PT versions of this, is Pendle tokens, fixed rate stuff. It's those Morpho vaults for Athena are less about the SUSDE token itself and more about the fixed yield versions of these in today's incarnation. But more recently, actually, so we've onboarded the Athena protocol directly. So Athena's been around for a while. It's got good Lindy. They even survived like the Bybit hack, which I mean, this is a testament to the structure being much better than 2022, where there was lots of cascading issues. So we've been very impressed with the resiliency of Athena, and so we now do a direct allocation into the Athena protocol up to the, it's not aping everything in. There are like risk frameworks about the maximum amount that can go in to make sure that USDS holders are very, very senior in the stack and protected by many, many layers of insurance so that they can be sure that their investments are going to hold their value.
Gotcha. Yeah, no, and like I said, there was there was some criticism back then. Honestly, I personally was applauding it because it's funny, how the public is. They treat everybody unfairly, in my opinion. But like on one hand, you had people complaining that DAI was going to be surpassed by USDC and Tether and like these up and coming yield bearing stable, even Athena, right? Athena was going to threaten DAI's market share, and like you guys morphed, in my opinion, in that moment to like this where you kind of like left the confines of Maker and like the DAO structure that kind of like limits your decision making. And you guys are able to kind of be flexible now where you're able to take advantage of these kinds of risk adjusted opportunities. And ultimately, right, like kind of provide value back to DAI, back to, the Sky ecosystem, and really like conserve your market share, right, or expand your market share. And so that's the way I viewed it, at least, was just that this is the way that things should be working, right? We should have like a flexible model that these DAOs can use to to grow and can continue to kind of like remain relevant. And I really thought that you guys did an excellent job of that, and that kind of seems like what the vision is, I guess, for the liquidity layer moving forward, right? Is kind of taking advantage of these market opportunities when you see them, and then kind of adjusting from there. And to your credit, like too, we I think there was a lot of heat about like the amount of allocation to Athena within DAI's backing. And I think you guys, you can see that flexibility in that new dashboard you guys came out with, right? Because I think it's a lot less than it was, right? You're more allocated to T-bills now, versus what you were back with the funding rates. Um, so how do you view that? Is that something that you guys are? You said you have this off-chain logic, this off-chain algorithm, or whatever you're putting into it that kind of has a say in making these decisions, but um, how flexible is it? Is it as simply as you guys plug in other assets that you're seeing that meet the profile? Like how flexible are you guys looking at this in terms of the assets that we're seeing come on chain now?
Yeah, I mean, so the like basically under the new structure of the sub-DAO model, we can react quite quickly and basically um like behave. We're in a competitive environment, right? So like you do need to be able to react and grow and adjust to the market as rapidly as a, centralized company. So actually maybe I'll talk a little bit about the governance restructuring and how this has benefited then like how we're able to move so quickly now, while retaining decentralization once this system goes live for real. So previously under the DAO structure, a lot of the issues with us being able to react in real time to this kind of stuff was that the flat DAO structure, basically everybody is weighing in on everybody else's opinion, and like there's a super long bureaucratic process for making any kind of proposal in the forum. And so it was recognized this just doesn't scale, it doesn't work, we're going to be outcompeted. So like it just so the restructuring of the sub-DAO model is just been hugely beneficial to the protocol in that the sub-DAOs themselves can operate in like a much more centralized manner, and the whole system is kept decentralized because there's multiple sub-DAOs. So you basically have free market mechanics where these sub-DAOs compete to ensure that the system as a whole remains decentralized. And then Sky becomes very unopinionated. It's basically here's the rules of the road. Here's the assets that we allow as collateral and these LTV numbers and these types of counterparty risk and whatever. There's a very, very detailed. This is like one of the most detailed crypto risk frameworks that's going to be coming out very soon, actually. And then you as the sub-DAO, as long as you play within those rules, you can propose anything you want. And so you can, onboard, Athena or some other basis trade token, or, more recently we've onboarded Maple, which does like off-chain OTC lending, which is something that we didn't have access to before. But basically, you can operate however you want. And so this model is just going to be able to like if it's not even the one sub-DAO that's doing it, another one's going to do it, and if they make bad decisions, they're going to blow up, and well, not blow up, but they're going to fail, and gracefully the system is designed such that a single failure in a sub-DAO is not going to contaminate the whole system, much like in a free market businesses are going to fail, but it's not going to tank the whole economy. At least that's the job of Sky, to prevent that from happening. So this model, yes, it's going to be extremely flexible, retain decentralization at the DAO level for Sky. And yeah, it's like really we're going to be able to just continue to optimize this. And I think we're like, I think already like 90% of the way there of like the Spark liquidity layer just being this very general version of onboarding everything. And like as more and more things are just getting tokenized on chain, it's going to be as quick as, okay, this asset, we've done the due diligence, the legal structures look good. Let's onboard this other RWA into the Spark liquidity layer, and then it just make it part of the algorithm about when to allocate to it.
Yeah, no, I'm glad you brought that up, the T word, tokenization. So obviously, I think you guys started with like BlackRock and I think Centrifuge. Some of these tokenized versions of T-bills and other market structures. So how are you guys assessing that? I'm really curious about this. I've talked to a lot of funds lately, but with the future kind of pointing towards the tokenization of like everything, like what kind of legal structures are you guys looking for, or what kind of risk frameworks are you guys looking at in terms of these tokenized versions of these RWAs? Like obviously BlackRock is BlackRock. I think everybody's got high confidence in BlackRock. But is there certain things in like the legal structure you guys look for, like bankruptcy remote structures, or like what are you guys looking for there in terms of the way that they're structuring things?
Well, I mean, you named it yourself. Stuff like bankruptcy, remoteness, these are the types of things we look in the structure. But I would say in general, and this has been really great seeing the US move into a more like embracing crypto, regulating it, because I believe that with RWAs in particular, these should be heavily regulated, very simple structures like T-bills, like wrapping T-bills or wrapping, AAA corporate debt or something like just very, very simple structures. And then the interface is where there should be very, very tight regulations so that you as a holder of the asset on chain know exactly what you're holding, and there's no surprises with complex nested supply chain of loan stuff that's gonna cause like the great financial crisis, the global financial crisis of 2008, for example. So on the interface between the real world and the blockchain should be just these simple constructs, RWAs. And then once they're on chain, then because the blockchain is fundamentally transparent and you have all the data in real time, and this is part of like what we are so interested, we published this dashboard that you mentioned earlier, like Spark Data dashboard. You can literally see everything that's backing USDS right out to the last dollar in treasury bills or whatever else it is. And so this structure, yeah, okay, you're
Yeah, I
pulling
was
it
gonna
up
say, let
now.
me bring this up because just for for our viewers, right? This is this is like one of the most beautiful dashboards I've
Oh,
seen,
thank
and
you.
it's very in depth. So yeah, keep going. Right.
Yeah, so actually, if you want to go to the savings tab, so if you scroll down a bit, and I think a bit more. Yeah, okay. The backing breakdown. So this is what's backing all of the outstanding USDS liabilities. So you can see it's 2.25 billion in USDC, 1.5 billion in treasury bills. This is split between BlackRock, Centrifuge, Superstate, as you mentioned. And then like there's ETH backing and wrap staked ETH backing and CBBTC. And this sort of like this is like literally in real time and down to the last dollar. You don't need audit reports or anything like that. And like, so this is the future of investment in my view, because with this level of radical transparency, you don't have these opaque, hidden things that turn into systematic risk. You can identify them earlier. So like the stack CDO stuff from like the 2008 crisis, where these things were just filled with like garbage mortgages and just nobody knew, right? Because nobody was digging into it. Like I want to live in a world where it's like this is printed first and foremost on any dollar investment instrument, and you can like you can just ask an AI, if you're not an expert, like what is backing this, is anything risky, and it'll just it'll answer that. And so this, I think, is the true superpower of USDS, and Spark exposing this through dashboards. That's going to be a huge value add to society.
Yeah, I agree. And my favorite part is too is like you can see like so if you got $2.2 billion of USDC backing here, you can actually see what protocols you guys are routing that through. Morpho, SparkLend, Sky, obviously, etc. And you're absolutely right. And one of the things that I think a lot of people talk about, decentralization, and they get all bent out of shape about, blacklisting of wallets and stuff like this and censorship. But one of the things that you kind of inherit, on the other side of the spectrum is safety, with some of these tokenized RWAs, because if you're whitelisted to hold that token, so if you're whitelisted to hold a T-bill or a tokenized version of that T-bill, and you get hacked, you've actually got recourse to go back and like get your actual assets from the custodian or from the asset issuer, where you can kind of eliminate some of these blockchain problems. And that's one of the things that I think I'm most excited about as well. Is we see these hacks every day, right? We just saw a huge one yesterday on Sui, I think. But we've got to find a way to like eliminate that, or kind of mitigate that as much as possible for us to take the next step, I think. So yeah, it's definitely cool to see, that you guys have thought about that, and are kind of displaying that in your risk dashboards. So, we're talking about, RWAs again, we're talking about tokenizing. Let's talk about stablecoins for a minute. We did see, obviously some very positive traction in the US in the form of this Genius bill. But one of the things I'm curious on, particularly, I guess, to get your general take on the Genius bill, obviously, but secondarily, there's this little tidbit in there about issuing yield, right? where if you're not a registered stablecoin, or if you are, they want to bar you from being able to issue yield to holders. How do you view the Genius bill as a whole, and how do you view it as how does it impact DAI? How does it impact Spark and what you guys are trying to do?
Yeah, so I mean, on the regulatory side, DAI and USDS are fundamentally different from the stable coins that they're mentioning in this bill. So they're talking about fiat-backed stable coins. So this will be like USDC or USDT. So I view them as completely different products and actually quite complementary. So USDC and USDT, they're optimizing for maximum liquidity. They're interfacing with the banking system. They're kind of like sitting on the closest to like there's like a hierarchy of money, and so they're sitting closer to the Fed basically, which is the issuer of the US dollar. And so these things function more as like narrow banks where they're specifically supposed to most like they're entirely supposed to hold cash and cash equivalents, at least with the US regulated versions. And so this is an incredibly useful tool, and I think this should exist alongside on-chain yield-bearing stablecoins, which is where more like USDS sits. And so USDS is fundamentally on-chain, and by its design from its inception, it was like, issuing crypto-backed loans. So it's not meant to be a full reserve stablecoin, and not everybody wants a full reserve stablecoin. The trade-off is that you can get a much higher yield by giving up a little bit of liquidity. So USDS sits in this middle ground where it's more like it's not like huge duration or anything like it. It does optimize there, as you saw in the chart. There's 2.3 billion in USDC sitting there. So there's a reserve there that people can tap into for liquidity. But it doesn't. You don't need 100% of the balance sheet sitting in T-bills, so we can deploy it into all the stuff that the Spark liquidity layer deploys into, which is mainly crypto-backed loans, either on-chain, off-chain, or getting yield from the funding rate by doing basis trades, stuff like that. So I think there's just different products for different people, and I think we're just really at the beginning. I think in the more broad banking on-chain crypto yield-bearing stablecoins, I think there's just going to be a huge variety because there's not just one investment opportunity in TradFi. Why would it be the same for crypto? And right now, there's just not that many yield sources. There's really only like three. There's T-bills, crypto over collateralized loans, and then funding rate. And so we want to unlock more and more stuff. And as we see, I think the next major RWA that's going to come on chain is corporate debt, and we will see the biggest buyers of those as stable coins. And so this is now the fourth thing that we have. And so like there's just going to be more and more opportunities that come on chain. And with regards to the bill, I'm very happy this sort of legislation is going through Congress, because it means that, as I mentioned before, the interface, such as like the Circle or the USDC, should be highly regulated, or other RWA issuers, and they should just be very simple, highly regulated constructs that can be used as tools by once you get on chain.
This episode is brought to you by Pendle. Pendle is a leading protocol in the DeFi yield sector, operating as a permissionless yield trading protocol, facilitating the tokenization and splitting of any yield-bearing assets in DeFi. This allows users to speculate on future yield or earn a fixed rate on their assets. Learn more at pendle.finance.
Yeah, no, it makes sense. I guess, do you have any fears that, like, okay, it kind of seems like these fiat-backed stable coins are kind of getting the green light from a regulatory perspective? I mean, do you have any fears that that the yield-bearing stable coin, in terms of market share in the US, do you have any fears that it would dwindle, or you guys will have to like limit it a lot more than you do now? Like, I guess I'm just trying to figure out if there is like a risk, there for yield bearing stable coins versus like what is kind of getting the pat on the back from Congress. What do you
I think
think?
it's quite the opposite. I
Hmm.
mean, getting the green light will only grow the ecosystem as a whole. And there's, as the amount of people who are holding non-yield bearing stablecoins grows, there's going to be an increase in demand for some people who demand more yield from that. So this is going to grow the on-chain yield ecosystem as well. And I think, USDS and Spark we're in the best position as the largest on-chain stablecoin to benefit the most from this.
Gotcha. No, it makes sense. Um, So we're talking about, the next wave of RWAs kind of being the corporate debt. Um, like how do you think Spark is positioned to help bridge this TradFi DeFi kind of paradigm that we see now? I think you guys are announced to be deploying on Converge, the new chain from Securitize and Athena, I believe. Like how do you think like vehicles like that are going to play out, and how does this liquidity grow the pie for everyone?
Yeah, so I mean, yeah, I guess like stablecoins really are the Trojan horse that is onboarding all of TradFi one at a time. So originally, I mean, US dollars stablecoins are the original RWA, and this is the product market fit that crypto has. It's one of the biggest use cases we have so far. I think there's going to be more use cases, but this is the largest use case by far, and it's just growing and growing despite the market cycles of crypto. So I think it's already proven itself out. So once the interest rates went up in 2022, it was natural that it was going to drag in treasury bill products as well. This is the next layer because who wants to be earning zero yield when the risk-free rate is like 4 or 5%. But as the space continues to mature, like as I mentioned, the next thing is likely going to be stuff like corporate debt. But it's just stable coins are basically the thing that's just going to keep dragging more and more assets on chain. And once we reach a critical threshold, I don't think we're there yet. I think like I still haven't seen like a lot of demand in like stuff like stocks and stuff like that coming on chain. But I think there's this going to be this inflection point because of the huge capital efficiency, transparency improvements of crypto over the traditional finance system. I'm not a TradFi person by background, but I've been kind of dipping into it a bit in dealing with these treasury bill products and other RWAs. And man, oh man, it's crazy. Like, so I'm crypto native first, so I'm like used to just shipping funds around the world, no issue. But then you get into the banking system, and you're like, what is it, like T+1 settlement, and like somebody's got to like call somebody to send like it's crazy. It's like Excel sheets and all this like Fortran backing a lot of this stuff. Like it's just so slow. And so this is the benefit that crypto brings, and really we just have to get over this critical threshold where most of the assets are still in TradFi, and so they're still going to stay in TradFi because that's where all the network effects are. But because it's such a huge improvement to being crypto, as we continue to drag more things on chain, it's just going to get faster and faster as we start bringing all the liquidity on chain. So I really think we're just at the beginning, and there's like, I don't know how long it's going to take, probably another 5, 10 years, but I think it's going to like, eventually we'll reach this inflection point where TradFi is like just going to, it like first it's a trickle, and then it's like a raging stream, and then the dam breaks, and everybody's coming on chain with basically every asset.
Yep, that makes sense. And again, too, I view projects like Spark and Maker as like perfectly positioned, because when we do get, everybody talks about onboarding the normies and onboarding mom and dad and grandma and grandpa to crypto. But you got to have products like what you guys built with the liquidity layer that kind of abstract away all of this overabundance of choices, right? You don't want to get like overwhelmed by it, because it's easy to do that. But if you could just deploy your capital into something like the savings rate for Sky, right, and let Spark kind of handle the allocation for you and maximize for you what the returns are, um, then it just becomes like a much better product, I think, to onboard people. So it'd be kind of cool to see how that proliferates, over the course of the next 5 or 10 years as more and more people come on chain.
Yeah, for sure. And I mean, I don't think everybody needs to like go fully on chain. Like I think having, the DeFi mullet style where there's fintech in the front, and, your mom and pop and grandma, grandpa can just like use some sleek fintech app and don't even know it's blockchain backing it. I think this is probably going to be like the more common thing. Like not everybody needs like World War III resistant, I'm custodying my stuff in like a hole in the ground kind of structure. So I think there's just gonna the important part is what you mentioned. The Spark liquidity layer is meant to just cater to as many markets as possible to what the people want to, how they want to save and invest and stuff like that. And the other thing that you mentioned I think is important is the fact that the rates are quite good in DeFi, especially during bull markets, and it's increasingly becoming a scalable good yield. And so packaging this up into more traditional finance appropriate packages is going to be very important. So this is, I think, we've had like a Bitcoin ETF, we've had a ETH ETF, and maybe there's probably going to be a Sol one at one point. But I think USD stablecoin ETF is going to be the next ETF that's coming. So this is something we're looking at. We're very interested in because there's a lot of people fixed income that it's tapped out in TradFi. Like there's not that much to get. And so if you present DeFi yields, 7, 8%, 9%, mostly with crypto over collateralized loans in the case of USDS and on chain too. This sort of loan structure is highly robust. We've actually had no bad debt in Maker ever with these types of loans. So it's incredibly robust and the yields are quite good. So this is a very compelling product to TradFi, in my opinion.
Yeah, no, agree 100%. And I think that's when we'll start to see the flood of these RWAs actually coming on chain. We're starting to see it now, but if you can actually create a reason for like these asset issuers to bring T-bills on chain or to bring corporate debt on chain or whatever, they're going to come if there's a financial gain there, right? And I think that's the final boss is regulation, obviously, but then also can we actually like make more money with these assets on chain than you can off chain, right? So like looping against these T-bills, right? That's done in TradFi, but it's very gated. Like you can't get access to that, unless you're at a certain income bracket, right, or a certain accredited investor. Versus on the blockchain, you could go do that tomorrow, right? That's the beauty of it, right? And I think that's why ultimately these assets will live on chain, and a lot of the financial world will move on chain,
Yeah.
eventually.
And I think it's very interesting what you mentioned. I think like there's this whole bunch of people who are like deep in DeFi, like doing these types of looping, who would never be exposed to this type of detail, like the mechanics of how finance works, and like this great detail is just such a, you can get your hands completely dirty in this stuff without TradFi. It's like you're so far removed from this stuff, and everything's just like black boxes. You don't really understand, and there's authorities saying this is safe, this is not, but you just like it's just I don't know. It's kind of a weird side effect of DeFi being guts out all in the open, where people can really just get involved and mess around with this stuff. Just as a side, I think that's very cool.
No, you're absolutely right. I mean, like I'm a living testament. Like I didn't really have a finance background when I got into this. And now I'm talking about, tranching and RWAs and portfolio structure for all these, exotic assets. It's just only in DeFi, right? And that's the beauty of it. So we're coming up on the end of our time. Before we do, though, I want to talk about the Spark token a little bit. So you guys just made some announcements about the Spark token in terms of how people can earn points. I think Pendle was kind of like one of the opportunities you guys introduced to the market recently. So let's talk about the path to the Spark token and what is the utility for it ultimately that you see. One of the questions I have is like, obviously kind of maker governance, has a say in like what the savings rate is and kind of like, decisions that could affect the Spark protocol a little bit, right? But then you've got the Spark token, and I'm wondering like, is there going to be a clash between Spark governance or Spark token holders and Maker? How do you see this playing out? I guess to keep it short.
Yeah, I mean, so first, like, there's not going to be a clash because the two are actually quite complementary by design. So, Sky is basically just setting the rules of the road for all the sub DAOs, or they're called stars as well, to play. It's like the sandbox rules about how you can play and what the risks involved are, and how much all this tranching stuff you're talking about. Like there's all these rules about how to tranche the investments and stuff like that. And so, but then sub DAOs like Spark is the first, but there will be others, are able to just invest however they want. And so, I'm not going to say it's the exact same thing, but I think the relation is most closely analogized by a central bank, which is Sky, and a commercial bank, which is more like Spark, where the central bank just delivers liquidity to all the commercial banks. And so, but they're very unopinionated. They charge the same rate to all the banks to borrow, and the bank's just paid, and then they can do whatever they want with it, and they all earn net interest margin on top of that. And so this is where Spark's business model, and in a sea of actually protocols, I mean, there's been a kind of a big renaissance towards fundamentals recently. And so if you want fundamentals, like Spark is a revenue generating protocol by even out of inception. So like this is going to be where you can get fundamental value. There's revenues, and just like any net interest margin business, there's retained earnings for the protocol.
That makes sense. That's a good analogy. That actually struck home for me. And I think that makes perfect sense. Well, we appreciate your time, Sam. I know it's precious. I'm going to get you out of here. For anybody listening to the podcast, obviously check out our show notes. You can find Spark, there. You can find Spark on X and in the internet virtual world. But then also, Alia Research will be publishing some work, on Spark, right? So if you have interest in diving in, certainly keep an eye out for that information. And we'll see you guys on the next episode of Proof of Vision. We appreciate it.